Okay guys, this is Jeff here with FXMShift, and today we're going to talk about how to determine higher time frame bias. Now we're going to start with a top-down analysis, okay, and we're going to go from a macro to an intermediate to a short-term perspective on the charts. Now that's going to translate to looking at a monthly chart down to a weekly and then to your daily charts. Now, the reason why we look at the higher time frame charts is because they provide an institutional directional bias. Okay, that means that large institutions are going to be trading and keying off of these higher time frame open and close prices. And since there are massive amounts of volume in these moves, we want to do our best to make sure we trade in line with them. Now, the monthly chart is going to give you a macro institutional bias, meaning long-term trades. Okay, so if you're looking to be a long-term trader, position trader, trading for weeks and months at a time, right? The monthly chart is going to give you that macro institutional bias for you to be able to determine the trend, and the direction you should be trading. The weekly chart is going to give you an intermediate institutional bias. So if you're looking to be a swing trader, short-term trader, trading for anywhere from a few days to a few weeks, okay, the weekly chart is going to give you that kind of insight. And then finally, the daily chart is going to give you a short-term institutional bias. Okay, so if you are an intraday trader or even a scalp trader, you're going to want to refer to the daily chart for that direction and the bias. Now, these are all because the higher time frames are where the large institutions are watching and what they're doing their analysis on. Okay, whereas something like the daily chart for an intraday trader like us, or scalp trader if you're a scalp trader, is going to be considered something like a higher time frame. For institutions in the large banks, the daily chart is basically kind of just like their normal executable time frame, like a short-term chart for us. Okay, so that's why it's important to be looking at the overview of all the higher time frame charts to give yourself a top-down analysis, so you can give yourself a directional bias to be trading. Whether you're trading long-term or short-term, it doesn't matter. You need to have a good idea of what the market is doing in the bigger picture. Okay. Now, we're going to teach something today called the open, high, low, and the close. Okay, now this is something very basic, very generic. In the MT4, you can see it in your candles when you hover over them. They're also represented by a bar chart, but it's important to understand how the open, high, low, close relates to price action across all time frames. Okay, because once you have the directional bias pegged, you're going to be able to know where to look for your optimal trade setups and pinpoint your entries. And I'm going to show you how that works out in a few chart examples in a little bit. But also note that price action is it's fractal in nature, so we look for the same kind of behavior and the patterns to appear on all time frames. Okay, so anything that you see happening on a monthly chart, a weekly chart, a daily chart, that kind of behavior will also happen on a 1 hour chart, a 5-minute chart, even a 1-minute chart. You're going to see the same things, patterns, behaviors repeating over and over and over again. Okay, now how it relates to across all time frames, I'll show you in a bit. But when you have an idea of how the monthly is going to be moving, then you're going to also have an idea of how the weekly is moving, how the daily is moving, and so on and so forth. It's going to give you that bias and that confidence to know which way price is going and what setups you should be looking for going forward. Okay, open, high, low, close. A very quick lesson and depiction here. You can see here I have two candles. Okay, a green candle and a red candle. Obviously, a green candle is going to be bullish, and then we have a bearish candle here on the right. All right. Now, the open, high, low, close basically refers to when the price opens on a candle. Okay, it'll open here, down here at the bottom, and then it'll trade down to a low. Okay, which will be depicted by some kind of a wick. And then price will continue to move up and up and up and up and up until it makes a high. Okay, and then it'll come back down a little bit, maybe create another wick, and then it'll close over here. So this is the nature of a bullish candle, and how we know it's bullish is because price has moved up from an open down here at the low and a close up here at the high. Okay, so it opens lower, closes higher, we get a green bar, and we know that we have a bullish price action move denoted by the green bar. Conversely, we have a bearish candle, so the same conditions are going to happen, except on the flip side, we're going to have the open up here. Okay, it's going to trade up to a high, all right, maybe create a wick and come down and make a big body candle down here as price goes down lower and lower, down to this low. Okay, then it's going to come back up and close right about here, and then create some kind of a wick. Okay, so this is the opposite, obviously, of the bullish candle. We have a bearish price action here because we know that the candle, the price, sorry, has moved down, opening up here, okay, and then closing somewhere in this range. Okay, now obviously this is just an approximation. You know, the candles can be different sizes, the wicks can be different sizes, but this is generally the concept of the open, high, low, close. Okay, so this is how you would read a candlestick chart. Okay, and this is how you know where price opens, where it closes, the range of the candle, okay, the high and the low depicted by the wicks, all right, and then whether the price has gone up or down, right? If it's gone up, it's going to be a green candle, and if it's gone down, it's going to be a red candle. Now this can also be depicted a different way, okay, on your chart, and with something called a bar chart. Okay, now a bar chart looks like this. This is going to be the formation that looks for the bar chart. Okay, and it basically gives you the same kind of information. Okay, the tick to the left here represents the open, and the tick to the right represents the close. Okay, so this would be a bullish bar chart where the open price is here. Okay, comes down to a low, makes a high, and then comes down and closes here. Okay, and then we have bullish price action because the price has gone from low to high. Right, and on the flip side, we have a bearish bar chart here that we have the open. Okay, it trades to a high, price moves down to a low, and then closes here. Okay, so the same kind of information basically you're getting from candlesticks depicted in a different way in a bar chart. If you go to your MC4, there's an option up there to at the top. You can select bar chart, and you can see these depicted on the charts instead of candles. Okay, this is just so that you have a better picture of, you know, where the price opens and where it closes, and you know, as it relates to what we're looking for in price action, it's very important. Okay, because given this information, what we're looking for is if price action is bullish, okay, what we want to do is we want to be buying at or below the opening price, right? If you have a bullish candle here, if you have bullish price action or bullish bias, where do you want to be buying and where do you want to be exiting the trade? Obviously, the best place to buy is going to be down here at the low, the very low, okay? But anywhere in this range here, from the open to the low, is going to be a good spot to buy. An optimal setup is going to be right around here, okay? Because price is going to go up, okay? It's going to create a high, it's going to close up here, and then this is where you're going to want to exit, right? On the flip side, if the price action is bearish, we will look to sell at or above the opening price up here, right? It's the same thing except flipped. Obviously, if it's a sell candle, we want to be selling at the high or to the open, somewhere around this range right here. This is going to be our optimal entry point, okay? And then price is going to go down, it's going to make a low, and it's going to close. All right, same thing with the bar chart, same idea. We want to buy over here, okay, or at the opening or near the low, and this is where we want to get out. And then at the sell, on the sell side, we want to be selling at the high or the open, okay, and we want to be exiting over here. All right, now if you're thinking about monthly candles and weekly candles, one candle represents a month, okay? If the month opens here and we buy, okay, over here at the open, the rest of the month is bullish, then we've made a lot of pips, right? So when I say price action is fractal in nature, that's what I mean, is because a month's candle and a month's data, in between this, you're going to have many different candles on the lower time frames that basically depict the same idea. But if we can understand if that the monthly is bullish or the weekly is bullish or the daily is bullish, then you can go down to a lower time frame with the same bias in mind and know which direction to trade, right? And then from there we can determine if price action is bullish or bearish. Then we'll look to buy or sell at or below the opening price if it's bullish, and above the open price if it's bearish. Okay, so now you're probably thinking, whoa, whoa, whoa. You have some explaining to do. You haven't actually told me, Jeff, how to find out whether we are bullish or whether we are bearish, right? How do we determine the bias on the higher time frames, how do I know if we're going to be buying or selling, right? What's the missing piece of the puzzle that I haven't given you? So I'm going to teach you guys something very simple, a very simple concept. Okay, a simple but powerful 3-candle pattern to determine bullish or bearish price action. Okay, now don't mind the color of the candles. The color of the candles do not matter. But this 3-bar pattern, okay, is what we generally call a swing high. All right, so that is because we have a high in the middle, okay, and then we have a lower high to the left and a lower high to the right. Okay, this also includes the wicks. Okay, so but just as a general concept, this is the kind of formation that you want to see on the chart, right? This is called a swing high. On the other end of the spectrum, of course, we have what we call a swing low. Okay, and that is because we have a low in the middle and we have a lower low to the left and a lower low to the right. Okay, this simple 3-bar pattern is going to be a big key in determining whether or not you are bullish or bearish. Okay, and then when you apply this to the higher time frame charts for your top-down analysis, is going to be a major indicator in the direction of the trend and the price. Okay, so let me show you guys how that works when we find a bias. Okay, so in a bullish bias condition, what we want to look for, okay, is our swing low. Okay, so you're going to watch for a swing low to form. Okay, 3-candle pattern, higher low to the left and a higher low to the right, and this is our swing low. Okay, now the high of the 3rd candle, what we're going to do is we're going to wait for that 3rd candle's high to be rated on the next candle, okay, which that does right there. Okay, so what you want to see is you want to see price be willing to trade through or above, right, the 3rd candle's high right here. Now remember, this encompasses wicks as well, right? So this could be a wick, it could trade through as a wick, right, come back down, but generally what you want to see is you want to see the price action be willing to go through the 3rd candle's high over here. Okay, and then what's going to happen is after that point, when that candle closes, you will be in a bullish bias condition, and you're going to be looking for the previous highs of each of the successive candles to continue to be rated, okay, until you see another swing high form, okay, or price reaches a key resistance level. Okay, now on the flip side, for bearish bias conditions, okay, you're going to be looking for the same thing, right? You have a 3-candle swing high, so you're going to watch for a swing high to form, okay, lower high to the left, lower high to the right, and the 3rd candle's low, right? What you're going to do is you're going to wait for the 3rd candle's low to be rated on the very next candle, just like that. Okay, now you want to see the price go through the 3rd candle's low, all right, with the next successive candle, and once that happens, you will be in a bearish bias condition. Okay, and then you're going to look for price to be rating the lows of each successive candle until a swing low forms or price reaches a key support level. Okay, now let's look at how that relates to a chart, and then we can talk about that in more depth and you can look at some details. Okay, so this is a monthly chart for Euro USD, right? And you can see here on this chart, I'm just going to pick this swing low right here, okay, as an example. So this swing low, you can see here the wick of the candle is the low right here. There's a lower a lower low to the left, a higher low to the left, I'm sorry, and a higher low to the right. Okay, so this is the swing low right here, the 3 candles right here that we're looking at, this candle, and this candle. Okay, as I said, the color of the candles doesn't matter, right? It could be bullish or bearish, but we're looking for the lows to form this 3-bar pattern. Okay, now what we're looking for on the next candle, on the 4th candle, is we want to see the 3rd candle's high right here be rated on the next candle and traded through, which it does right here. You can see the wick goes above, right? So that means that at some point the price was above the 3rd candle's high right here and it traded through. Okay, at that point, at the close of this candle, you can be a bullish bias condition and look for buy setups going forward. Okay, and you can see the opening of this candle, the 4th candle here, or sorry, the 5th candle at this point, okay, trades above, okay, and is bullish and trades above the high of the previous candle, okay, and it does that for each successive candle, okay, until there's a key support, key resistance level here, okay, and it creates a swing high, okay, and then you can see price starts to come down after that. It does continue up, okay, afterwards, right, after it forms another swing low, and then the conditions are met again. But once we get to this point where we are at a key resistance level, or when you see price start to form a swing low, then you have to kind of be less aggressive and kind of back off on your bullish bias, and then you're going to have to wait for the conditions to be primed again. Okay, now remember, this is a monthly chart. Okay, so each of these candles represents several hundred pips. Okay, so imagine you have a higher time frame bias in the monthly. You know that you're in a bullish bias. You can be looking for buy setups for a very long period of time. And also, for the price to set up this way, it also takes a very long time, because obviously 3 candles represents 3 months. Okay, so you have plenty of time, lots and lots of time, to be able to set up the framework for a bullish bias condition on the monthly time frame, so that you can go down to your lower time frames and look for the conditions that are present in your bias. Okay. Now, just to depict this even further, we're going to go down to, if we look down at a daily chart, okay, this is the same monthly chart down to daily candles, okay, and these black lines here are all the depictions of the monthly opening prices, okay, of each of those candles, just to show you what we're looking for, okay. Now, monthly opening prices shaded in the boxes, okay, you can see where price goes below the monthly opening price, and then we go upwards, right? So what do we say earlier is that we want to be buying below or at the opening price, okay? And then you can see that price goes up each successive month, okay, as long as we're in a bullish condition, okay? So look at the formation, if you guys can see this, okay, on the chart, okay, of the open, high, low, and the close, all right? The opens here, we trade lower, all right, price moves up, and then it closes, makes a high, and then it closes, right? So this formation is seen in the candlesticks, okay, on the monthly, it's a candlestick formation, but this is basically what you're looking for, and this is how you know, basically, where your optimal trade setup is going to be, because for bullish bias, we want to be buying at or below the opening price, okay? Now, obviously, like I said, these are daily candles, so the range is going to be big on some of these candles. But you can see that, the relative move between high and low here, okay, where price is below the daily open price versus the move and the expansion that we get to the upside after that subsequent, price dwindling below the opening price, it's a lot bigger, right? The explosive moves are up because we have a bullish bias on the higher time frames. Okay, now going down to, like, say, a weekly chart, okay, so this is a weekly opening price chart, and also on the euro, I'm going to show you on the bullish side. This is a 1 hour chart, okay, but we've already, let's just say, for example, or assume that we've already picked up a bearish bias on the weekly chart, okay? So all of these weeks are denoted with the opening prices are denoted with this black line here, okay? And then you can see here that every time price is above or at the opening price, we want to be a seller, okay? Now, this formation, okay, is this bar chart formation on the chart, right? The open trades to a high, comes down to a low, and then closes, right? So same thing here. We have an open, trades to a high, comes down, and then trades back up to a close right here, okay? So every time that we see price above or at the opening price, okay, we want to be a seller in a bearish condition, right? Because for a bearish bias, we want to be selling at or above the opening price, right? Now, when the monthly is showing bullish action, then we want to see weekly price action to be showing the same direction, obviously, right? And when the charts line up, the monthly and the weekly, that's when you're going to get your big explosive moves. Now, that's not going to say that when the monthly is bullish, you're going to see the weekly also bullish at the same time. all the time, right? Obviously, there's going to be periods of retracement. You can see here that we have a break in market structure to the upside, okay? And then here, this might either be a pause, right, or retracement before going lower, or this could be a reversal, right? So there's conditions that you still have to pay attention to. It's not just that, you know, because the monthly is bullish, the weekly is going to be bullish and vice versa. But you're also going to have to understand that there's going to be periods where you're not going to get that harmony or that conjunction, right? So you're going to look for the conditions where the prices line up and the bias lines up, and then you're going to be looking for your setups at or above the opening price in the weekly. Okay, same concept. And then looking even down lower to a daily chart, okay, this is where we have daily opening prices. So this is a 15-minute chart, okay, and then you can see price here. Anytime that we are below, this is a bullish bias, okay, anytime that price is below the day open price, we have a bullish bias. We see the price move aggressively upward, okay, and then here as well. And sometimes we have consolidation periods, but overall, you can see that you know, this move up here at the end of the week, okay, was a very bullish move, and price kind of stayed below the opening price for a little bit, and then it shot up. Okay, and then right here you can see the market's gonna gyrate up and down, lower, and basically the highest probabilities in trading the daily when you have the bias on the daily is when the monthly and the weekly bias are also in alignment, right? Just for what I said in terms of the weekly and the monthly, you want the weekly to also be in alignment with the monthly, right? When all three of these are lined up, you're going to have very explosive moves like this, okay? But generally, if you have a bullish bias or a bearish bias, this is where you can find basically where you should be looking for your setups, okay? And it's going to be at or below the opening price when it's bullish, and at or above the opening price when it's bearish. Okay, so you guys can see here. This is like I said, the daily time frame is the executable time frame for the large institutions. So it's very important to be noting where the highs and lows are on the daily chart if you're an intraday trader looking for your setups, because those are the areas where the institutions are going to target is the highs and lows. That's where the liquidity is. That's where the stop losses are being placed, okay? And that's what they're going to look for. In a bullish condition, you're going to be looking for the highs of the previous day to be rated with each successive move, okay? And that's what we were talked about earlier with the swing high and the third candle and the fourth candle being the candle that raids the highs and the lows, okay? In a bullish or bearish condition. This is what we're looking for, okay? So we'll say this is the third candle. The fourth candle we want to see trade above, okay, the high of this candle here, which it does, all right? And then the successive candle we want to see trade above the high. Each successive candle we want to see trade higher and higher, right? So we can see here and here. The third, the fourth, and the fifth days all successfully trade higher, and that is the open high and low close formation that we want to see that's fractal across all time frames. Okay, so when we drop down to an H4, if we drop down to an H1 and then 15 and then 5, it's the same thing that we want to see happen over and over and over again. Okay, but this is going to be able to give you the direction and the bias that you're looking for. Okay, all right. So that's it for this lesson, guys. Obviously, this is going to be just the beginning parts. The market structure lesson that you need to glean from this is going to be also important to learn, and that's for another video, because obviously it's not always just looking for a swing high and a swing low on a different on the time frames. But this is just a start, okay? This is where you can start looking and building your bias and your framework on the larger time frames to give yourself entries and setups on your lower time frames going forward, okay? So I hope that was helpful, guys. I'll see you guys on the next video. If you guys have any questions on this, please let me know in the chats.